Good afternoon, everyone, and thanks for joining us for today's webinar, Investing 101. My name is Sherry Krizik, and I will be your moderator for today's event. Today's presenter is Jamie Barnett. Before we get started this afternoon, I do have a few housekeeping items that I'd like to go over. First, this webinar is being recorded and will be made available on demand within the next 5 to 7 business days. Please take the survey immediately following the webinar today. It only takes about 2 to 3 minutes, and it helps us decide what and how to best present content to you in the future. If you do have any questions during the presentation today, please type them in the question box, and I'll do my best to answer any of those questions, or I'll have Jamie answer them at the end of the presentation today. If you have additional questions after today's event, or if you'd like copies of today's slides, feel free to email us at webinars@lgfcu.org. And with all of that being said, I will now turn things over to our presenter, Jamie.
Thank you, Sherry. So today we are going to be talking about investing. We are going to be covering the very basics of what you need to know getting started with investing. We will not be covering specific investments or giving any recommendations on any specific investments because, again, this is just the basics and what the beginning investor needs to know going into trying to figure out the stock market. So if you have been on previous webinars, you know that I always like to start with a did you know, some interesting facts or facts that I find interesting anyway, and some statistics that I feel is important to share with you guys as we are going through the different topics. So, did you know that excessive trading can wreck your returns? To give you an example, most active traders end up receiving among the lowest returns for any given year, and that is calculated. So, for example, the annual performance of the S&P 500 between about 1997 and 2016 was around 7.68%. But for that same time period, the average return for an active trader was 4.79%. So as you can see, there's a difference there, and the S&P 500 performed better than the active trader did. Inflation can cut your purchasing power in half. So everyone knows what inflation is. It has been around 2.4% though. That is a period from March 2017 to March 2018. So if you have money that is just sitting in an account that isn't making at least 2.4%, then you're losing buying power, which means things are increasing in price faster than your money is growing. So that's what the losing purchasing power means. You should not count your home as an investment. So a lot of people view their home as an investment, but based on studies, the housing market has grown at an average rate of about 0.3% over the last century. During that same time frame, the S&P 500 has averaged 6.5% over the last century. So as you can see, counting your home as an investment, you're not going to get nearly the return as you would if you actually had your money in the market. Now that is not to say that is every single housing market, because some housing markets are exceptions to the rules. That is just a general blanket statement about how the housing market in general. Stocks rose 1,100-fold over the past 70 years. So this number still comes after there were several crashes. This includes the Great Recession and the Great Depression, and the stock market still, over that period, increased in value. So the lesson is the stock market continuously rises, even though it can have some downtimes. And you can slash your capital gains tax almost in half by being a long-term investor. We will get into the difference in long-term and short-term investors in a later slide, so I'm not going to talk much about this point right here, but keep that thought in mind as we are moving forward, because again, we will cover it again momentarily. Today we are going to be talking in general, what do you need to know when investing? What are the very, very basics? We're going to cover what stocks are and the features of them, what bonds are and the features of those, and then mutual funds and what the features of mutual funds are. We will also cover the very confusing topic of diversification and what exactly that means whenever you were talking about investing. Then, of course, we will have time for questions at the end. So, investing, the official definition is the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. So let me translate that to English for you. That means putting away money to be invested in the market in hopes of receiving a return that will be more than what you can earn on a typical savings account. It does require you to prioritize your financial future over your current wants because, in general, investing tends to be a longer-term endeavor. It doesn't necessarily have to be years, but it's usually longer than a few days for most people. Investing is a tool for building wealth, but it is not only for the wealthy. I like to call this making my money work hard for me, so I don't have to work as hard. And then there are different types of investment accounts that you need to be aware of. There are taxable, tax-deferred, and tax-free. So a taxable account would be something like a regular brokerage account. A tax-deferred account would be something similar to a traditional IRA or a 401k. A tax-free account would be like a Roth IRA. So here's where we're going to go back into long-term versus short-term investing. According to the IRS, long-term investing is anything that you hold over 1 year. So you're usually looking at long-term investing to be something along the lines of retirement or college savings. That's generally the mindset that we're in when we're talking about long-term investing. But you can still hold things over a year and it not necessarily be for either of those two goals. But to talk about the tax rate and slashing it in half with long-term investing, if you hold an investment for less than a year, then you're going to typically be taxed at a 25% tax rate. Some people will be in the 28% depending on your income, but most people fall in the 25% tax rate for short-term investing. A long-term investor, though, will only pay about 15% tax rate. So it's quite a substantial difference whenever you're talking about money that you want to give to Uncle Sam. So it's important to know that holding an investment over a year can really reduce the amount of taxes that you owe whenever you recognize those gains. So let's get started with what is a stock. The basic definition is its ownership in a company. As a result, you have a claim on the company's assets and earnings. Now, that does not mean that you can walk into the company's headquarters and take their paper or their pens or their chairs because you have ownership in the company. It works differently than traditional ownership. You own a share of the company that they have issued. Companies issue stock in order to raise capital to undertake new projects, so to raise money so they can spend it on doing other things such as expanding the business. There are two types of stock, common and preferred. As you can see here, common is the most common out in the marketplace, but we will cover preferred too. So features of common stock, the biggest one is limited liability. So what that means is you cannot lose any more money than what you invest. So if the company were to go under for whatever reason or file bankruptcy, you will only lose the amount that you have invested in their stock. The creditors, any creditors of the business will not have any right to your personal assets. You do have the right to vote in shareholder meetings. So every year you'll get a notice of the annual shareholder meeting. If you can't attend, then you can request a proxy so you can vote on the important topics that they will be discussing and then send it back in. Very similar to presidential election or whatever. If you can't actually physically be there to vote, you can request the absentee ballot. That's the same concept. You will receive dividends if and when they are distributed, but it is not guaranteed. And then you have the right to sell your shares to someone else at any time. There's no holding period or any restrictions around selling your shares to someone else. The features of preferred stock, it actually is more similar to bonds than the stock that we just went over. We're going to talk about bonds next, but preferred stock still has the limited liability. You do have a guaranteed fixed dividend though. So you have guaranteed interest payments that will be made, or dividend payments that will be made on the stock, very similar to what bonds or how bonds are set up. It can be callable though. So that means that the company can call back that stock at any time. And there's nothing that you would be able to do to stop it because it would be written into the stock document itself. So now we're going to jump into what is a bond. It represents a debt obligation of the issuer, and it is a fixed income security. So that way you can expect the exact amount of money that you will receive if held to maturity. And we're going to talk about the different terms on the next slide. But they issue them in order to raise capital to grow the business or undertake new projects. And the features are guaranteed interest payments, or also known as coupon payments. And then the payment of the amount that you actually loan the company will be paid back on the maturity date, which again we will talk about on the next slide. But the amount that you loan the company is also called the face value of the bond. So there are two types of bonds. You have government bonds and corporate bonds. They are exactly what they say. Government bonds are issued by the United States government or your local municipality. And then corporate bonds are issued by corporations, various corporations in the United States. There are different types of bonds for each individual class. As you can see here, I listed them out for you. Government bonds in general are deemed to be the safest investment that you can make at all. Corporate bonds, however, are rated based on a credit rating agency that goes through and looks at the corporation's financials and determines what the rating should be, so therefore it impacts the coupon payment that you will receive. So the lower rated companies, you will receive a higher coupon payment than some of the higher rated companies because you're taking on more risk. Here is a chart to break down exactly how companies are rated. So there's 3 rating agencies, and it's Moody's, Standard & Poor's, and Fitch. As you can see here, you have the different letters, and the different letters mean the different grades of bonds and the risk that you're taking. So you can think of this as almost like the credit report for a company. And so as we get down closer to the C's and D's, or bonds that are deemed as junk bonds, you have a much higher coupon payment that will be paid to you than if you were investing in one of the AAA bonds up at the top. So here is a bond example. So how exactly does this work? You give the corporation $1,000. They tell you that you are going to be receiving a 5% semi-annual coupon, and your maturity is not until 10 years. So what does that look like? Well, you will receive $100 a year in coupon payments, and over the term of the 10 years, you will receive $1,000 total. So your total repayment, once the 10 years is over and the company has repaid you your face value, you will have received $2,000 on your investment. So you will have made $1,000 and then you'll get your $1,000 that you invested back. So again, this is just an example. The coupon payments can be anything, any percentage, depending on the risk that you're taking. Maturity can be up to 30 years versus 10, and then the face value or par value of the bond can vary as well, depending on the issuing agency. There are such things, though, as zero coupon bonds, and these are bonds that don't pay the coupon each year, but they are offered for sale at a discount. So you pay a discounted price, and then whenever it matures for the entire face value of the bond. So given the example from above, you could have a bond that has a face value of $1,000, but you only pay $850 for it, but when it matures in 10 years, you will get the full $1,000. That is how you earn your interest on zero coupon bonds. So your investment does grow, you just don't see it coming in every year like you do for a traditional bond issue with a coupon. So where do you buy bonds? Bonds are one of the investments that you can buy outside of an investment account or a retirement account. You can get corporate bonds from independent bond brokers and investment firms, and you can buy government bonds through Treasury Direct, directly from the government itself. So now let's talk a little bit about what is a mutual fund. So a mutual fund is a managed portfolio of stocks and or bonds created to accomplish a set of objectives. And we're going to talk about some of those objectives in just a moment, but it is managed by a mutual fund manager. And this manager can be an individual, it can be a team of people, but ultimately they are in charge of making sure that your mutual fund is performing according to standard. So there is actually an investment advisor behind it, operating it in the background. They are issued to attract smaller investors. So they typically are not issued by corporations themselves, but rather made up of a bunch of different investments that corporations do issue. They provide professional management, like I just went over. They are managed by a mutual fund manager. Diversification, because you will have a bunch of different investments inside the one mutual fund. So just by investing in a mutual fund, you have some sort of diversification already. There's a lot of variety that you can invest in a lot of different sectors and different types of equities or bonds, and we'll talk about that on the next slide. And then it's simple. You invest in the mutual fund, and there's nothing else you have to do because you won't actively be making sure that the mutual fund meets the standards. The mutual fund manager will. And then typically they are a lower transaction cost than buying and selling individual stocks. So here are the basic types of mutual funds. Most of them are pretty self-explanatory. So a stock fund or an equity fund invests all in stocks. A bond fund invests all in bonds. And then there's money market, so that's safe short-term debt, most of the time government debt. There are income mutual funds, which is focused on providing steady income for the investor. Balanced funds that focus on safety, income, and capital appreciation. Typically, there is a 40-60 mix where it will be 60% stocks and 40% bonds. There could be some cash in there as well that breaks up that mix. Or it could be 60% bonds and 40% stocks. It just all depends on which one you invest in, but there is typically a 40-60 breakdown. Then there are global or international mutual funds. Exactly what it says, it's investing in international companies. Then there are these things called specialty mutual funds, and these can get very interesting. So you can have sector mutual funds, which means that it will invest in a specific sector. So like finance or medical or social media or whatever. It invests in just that specific sector that you were talking about. And then there are regional, in which it invests in certain regions throughout the country. So for example, it could invest in companies in Latin America, or it might be a little bit more targeted to a specific country like Brazil. There are socially responsible mutual funds as well. And these funds do not invest in things such as tobacco, alcohol, weapons, or nuclear power. There's some religious groups that don't want to invest in things such as those, so there are mutual funds made that specifically exclude those types of investments. And then there's index funds, which replicates a specific market index. So the S&P 500, for example, you can have an index fund that is built very similar to the stocks that are on the S&P 500. So that mutual fund should replicate what the S&P 500 does as far as performance. It should go up when the S&P 500 goes up and go down whenever the S&P 500 goes down. So diversification. There can be a lot of confusion surrounding diversification. Its basic definition is a risk management technique that mixes a wide variety of investments within a portfolio. So that is essentially not keeping all of your eggs in one basket. But where it gets confusing is a lot of people think that that means that you have to have money in different locations. So at several different banks or several different investment firms, or maybe you keep money in old 401ks because you don't want to combine it in one 401k. And that is not the case at all. Diversification comes in whenever you're talking about the investments themselves. And there are some investments that are already diversified, so you don't have to worry about this, but if you're looking at individual stocks or bonds, then diversification becomes a little bit more important. So how do you diversify if you want to be an active investor? Well, it takes a lot of research, a lot of time. You have to make sure that you are spreading your money between many investments, including stocks and bonds. You have to constantly monitor the market so you know when to buy and when to sell. You also need to make sure that you are continuously adding hot stocks as they pop up, and then of course some active investors will invest in mutual funds as well. So it involves a lot of time. And so not everyone is an active investor. Most people I know fall into the passive investor category. So you don't necessarily want to be monitoring the market every single day. So how do you diversify in a situation like that? The two most common ways is to invest in either an asset allocation fund or a target date fund. An asset allocation fund, as you can see here, generally focuses on a specific goal. So it is going to be focused on being aggressive, balanced, conservative, or any other type of combination. It is going to have a makeup of investments such as you see here. Most of the time, the investments among the different asset classes are the same. So for example, if you're in an aggressive growth, it might have the exact same makeup of stocks as the conservative. It's just invested in those stocks. The conservative is just invested in those stocks a lot less. Now with these funds, you are already diversified amongst all the different areas. You have already set your objectives, growth, aggressive growth, whatever, but it is not going to adjust based on your personal situation. So for example, if you invest in an asset allocation fund and you choose aggressive growth, it will never turn to growth, balanced, or conservative on its own. You will have to physically go in and change the asset allocation fund that you are in. So sell it and buy a new one to reflect your new investment strategy. Target date funds is another very popular way. Target date funds are best known for being in 401ks or IRAs. However, they can be invested in through regular brokerage accounts as well. It is not just a retirement investment vehicle. But you choose the time frame in which you are looking to invest. So a lot of people will choose the year they're going to retire, let's say. So the further out the year, the more aggressive the funds. They work very similar as the asset allocation funds. Typically, they are all invested in very similar investments. It just depends on how far out you are is how it will determine the aggressiveness of it. So the closer to retirement you are, or the closer to the target date you are, the more conservative it will be. And these funds do automatically adjust themselves. So there is a mutual fund manager behind them that makes sure that as you get closer and closer to, say, 2055, you're getting more and more conservative with each 5-year increment. And those types of funds, you don't have to do anything. You don't have to make any changes because it will become more conservative over time just by its simple nature. There is not a right way or a wrong way to invest. It is just whatever you feel comfortable with and whatever makes the most sense for your situation. One requires a lot more time and research, and the other one is more of a set it and forget it type mindset to some extent. So you will find what works for you, and you will be able to invest accordingly. So that is the very basics of investing and the very basics for the 3 types of main investments there are. I'm going to turn it back over to Sherry so she can share with us any questions that came in during the presentation, and hopefully we'll be able to get you some answers.
Thanks so much, Jamie. That was great. I actually do have a couple of questions that came in. The first one is, does LGFCU offer investment accounts?
Ooh. That is a great question, and LGFCU actually does offer investment accounts. We offer 2 different types. We offer our brokerage accounts through our branch network, and then we also offer investment accounts through the Financial Wellness Department through Members Trust Company. It is all going to be dependent upon your needs, how much you want to invest, and what exactly you're looking to accomplish. As to which one is going to be the best way to go. So you are more than welcome to email us at webinars@lgfcu.org or give us a call at 888-732-8562, and we'll be more than happy to take a deeper dive into your personal situation to figure out which route would be the best for you.
Great, thank you. I'm going to actually skip ahead because this is a great follow-up, I think, to the question that you just answered, and that is, are our brokerage accounts covered or protected by FDIC?
That is a really good question and a very common one. So they are not backed by the FDIC because no investment can be guaranteed as far as performance. So there is an inherent risk in any investment that you make. However, like I said in the presentation, there can be some safer investments than others, but the FDIC does not back or insure any investments or investment accounts.
Great, thanks. Another question, Jamie, you had referred to callable bonds. What does callable mean?
So callable is a term in which corporations will use so they can call back the bond. So if you, for example, lend them $1,000 and you have a 10-year maturity, the callable feature will allow them to call the bond back from you prior to the 10-year maturity. So you might be 6 years into the bond and the company says, okay, we're going to go ahead and pay you the $1,000 you invested and your coupon payments are going to stop. So that is what callable means, and if you do purchase a callable bond, you are well aware of it in advance, so it's not going to happen out of the clear blue. You will know that's what you're investing in.
Okay, thanks. I do have, it looks like, one more question, and that is, what exactly is the difference between a stock and a mutual fund?
So the difference in a stock and a mutual fund is whenever you invest in a stock, you are investing in one individual company. So for example purposes only, you will be investing in Apple or IBM or Duke Energy all separately if you buy shares of stock. Whereas with a mutual fund, if you buy into a mutual fund, you might be investing in Apple, IBM, Duke Energy, Twitter, Verizon, and all kinds of other companies all at one time. So you're buying into a diversified portfolio that is made up of a bunch of different companies versus just one.
Thank you. I actually do have another question that came in. Jamie, what % of your income should you typically invest? Ooh, that's a loaded one.
That is a loaded question. So it really depends on your personal situation. However, I will say in retirement accounts, it's generally recommended for you to be investing anywhere between 10 and 15% into a 401k or IRA, or a combination of both. However, as far as brokerage accounts, so the investing that you would do outside of retirement, that is going to depend on what your capability is as far as your finances. There is no minimum to invest. However, you would want to take a look at your budget and decide where you might have some wiggle room or some extra money laying around that you would be able to put away into a brokerage account to invest in the market.
Okay, great. Couple of questions. Well, I know we're running close to our time, but a couple more questions have come in, so I want to try to get them addressed. What are the tax implications on the gains?
That is a very good question. So it depends on what type of account it is in, and it depends on what type of investment it is. But I'm going to talk in general terms. So you don't have to pay taxes on any investment until you recognize the gain if it's in a brokerage account. So that means whenever you sell it, that is when you will pay the taxes, and that is when it will be determined from the IRS if it was short-term or long-term, and the applicable tax rate will be applied. If it is in a retirement account, a traditional IRA, or a 401k, then you do not have to worry about taxes until you take the money out of the retirement account, and that is going to fall under your normal tax rate, whatever it happens to be. There won't be any long-term or short-term gains to worry about. And then for the tax-free accounts, for the Roth IRAs, there's no taxes for you to have to worry about anyway, as long as you meet the specific requirements set forth by the IRS.
Okay, great. Actually, the last question that I saw you had already answered, so I'm thinking that's probably about it for questions. I'll give it another moment. Looks like not. So this will bring today's webinar to a close. I would like to again thank you, Jamie, and all of you for participating in today's event. We really appreciate it. Just a couple of quick reminders. Once again, today's presentation will be made available on demand within the next 5 to 7 business days. If you do have any additional questions once today's event is over, or if you'd like copies of the slides, go ahead and email us at webinars@lgfcu.org. And again, please remember to take the survey when we're finished today, because your feedback is very, very important to us. And then finally, just so that you know, we will be taking a little break from live webinars for a bit because vacation season is coming upon us. However, we will be making new on-demand webinars available from May through August, so be on the lookout for more information on that. And so with that, I say to everyone, thank you, and have a great rest of your day.